Welcome to this YouTube channel on how to buy a business no cash down. I'm Carl Allen and I've been buying businesses now for almost 25 years, more than 250 deals in 17 different countries. So this playlist is all about deal making basics, the fundamental rules of what we do to take over someone else's established business without spending our own money. Here's the next video in the sequence. There are 6 in total.
Step 3 is quick and basic research and analysis. So with the many opportunities that you'll have from the methods earlier, it's time to assess both their quality and then map them to your tracker and filter them. So this is my origination funnel. I try to start with about 100 opportunities that are all unqualified, then quickly eyeball all of them to pick the best 50 or so that I believe will be the best fit. Now you don't need to start with so many. You'll need to have at least 5 opportunities yourself, but the more you originate, the more choices that you will have. I then filter the 50 to create my A list of the top 20 opportunities, and then I force rank them best to worst before approaching. And let me show you how I do it. So to get the top 50 or so, I just do 5 minutes of basic research on their websites. If I like the feel of the business, I keep it. If not, I discard it for now. Next, we need to pass these businesses through 2 filters. Now the first filter is a size filter. Going back to Matt's deal tracker, he determined that he needed a $4 million a year sales business to hit his wealth creation plan and be in the 0.2%. So I'm using sales revenue as the filter, as this is what really helps you. Now most businesses have got to file accounts publicly. In the UK, the Companies House website or other free sites like GOODWILL.com list all the financial information. In the USA, there's hundreds and hundreds of these sites. The popular ones are Hoover's, you've got the SEC public site, you've got Edgar's, you've got Moody's, there's tons of them. Now all you need to do at this stage is find both annual sales revenues and the number of employees, like in this example on a UK business called Paul Murray. Now there's tons of other information here, but it's not important yet because the owner will give us all the data that we need later in the process. Now if you can't find the sales numbers for all your targets, you can always get employee numbers if you look at the business's website. Then use a minimum of 5 targets where you have both sales and employee data and create a ratio. Now in this example, it's £133,000 per employee in sales. So take an average over 5 businesses and apply that number to all the others you have so you can have sales data for all these businesses. And then what you do is you pass all your opportunities through that filter. The business must have the minimum sales number to hit your wealth creation plan. Next, the second filter is all about reason. So for burned out owner managers, you need to check the desperation to get out. Now all the origination methods discussed earlier will tell you something. All those touch points, all that information that you've got, whether it's been a referral from your network, whatever, you'll know that there's a reason or something. Now you only need one of them. Is it there's no succession plan? The owner's tired, frustrated, they're ill, sadly dying, whatever. Make sure you've got at least one. And for investors, make sure that you have at least one from either a recent big exit, they're actively out raising new money, they've got lots of older investments from the research that you've done, and there could be evidence of other write-offs. All of this will have come from your basic origination research. And it's the same for changing big business. Look for new leadership, new strategy announcements, evidence of other sales or write-offs like Npower. Again, your research will have told you all this from step 2. So now you should have a maximum of 20 filtered qualified opportunities that fit your spec, your tracker in some way and meet your wealth creation plan. However, you only need at least 5, but no more than 20 at this stage. If you've got more, park them on a B list for later. So we're now going to do some more work on this A list and rank them both in terms of fit to the tracker, which I call related, and then the general quality gut feel of the business, which I term attractive. So the businesses that fall into the top right of this matrix will be your hot prospects, and let's see how we plot them. So taking your deal tracker, you need to rate a maximum of 4 metrics from 1 to 10 for each target. You could even just have 1 if you wanted to, but a 10 on whatever the metric is will be a perfect match, yet a 1 can be a deal breaker. You need to add them all up as the total is important. So taking Matt's list, target 3 only scored a 2 for location as it was 200 kilometers away from his house, but target 2 was very close by. And the same goes for quality. These are the 4 metrics I always use, but you only may need to have one, or you may have other metrics of your own. Now you need to look at each business in terms of quality. You may only have, as I said, one metric, but I always pick the quality of the customers, the nature of the products. Is it a commodity product versus the high-end product? I also try and understand what are the core USPs, the unique selling propositions of these targets linked to the market, and then what I term the gut feel quality. You may only decide that you just want to eyeball each business in and of itself just in terms of how you feel about it. You don't need all these different metrics. And what's great is all of this information that you need is in the public domain. But I always go just a little bit further. I do things like anonymously call each business, pretending to be a customer, and I also use my professional network to look under the hood of all these target businesses. And I also do a drive-by, especially if it's closed. Is it derelict? Is it modern? Is it busy, or is it a ghost town? And when I eventually meet the owner, more on that later, I'll share some of this insight, and telling the owner something that he or she doesn't know about their business, again, builds massive and instant trust and credibility. And then what I do is I just tabulate my scores. This one's for the deal tracker, the specification, and this was Matt's example, and then also quality. And then I plot them on my chart. Now, the larger the logo on this chart, the bigger it is in terms of sales revenue. Now, you don't need to do this. You can just plot them as you see fit. But I like to have as much information as possible on one page. Now, the targets in the top right-hand corner are the ones you go and see first, and then you work down to the right. That way, you're spending your time and your best opportunities first. Step 4 is all about deal structure. And for this, we need to briefly touch on valuation. Now, although the acquisition will not cost you any money, it's great to see what they are actually worth, and it's part of your wealth creation plan. Now, valuation is not an exact science unless you're a public company. In that case, find the share price, multiply by the number of shares in the market, and that's the market value, or the value of the business. However, in acquisitions, valuation goes completely out of the window. Sometimes big businesses have got to pay premiums to take ownership. Now, in this example, Microsoft, when it bought Skype, paid $8.5 billion for it, but Skype was worth less than $1 billion at the time. So Microsoft, it wanted Skype's 663 million users, as it was going to sell all of its catalogue of software products to them, and it was prepared to break the bank to get them. Now, even I've been known to pay a premium. I was part of the team that acquired Mercury Interactive when I was at HP. We badly wanted both of Mercury's customers and the software it manufactured. So we paid a massive premium using our shares, and it was still a great deal for us. But these days, I'm not using HP's money or shares, so I don't pay premiums anymore. In fact, I don't pay anything. From last time, this was a great business I acquired without parting with a single dollar. All of the $23 million profit will be mine when I sell it in the future. Now, even though a business is worth what someone's prepared to pay for it, either zero in our case or a humongously big premium if you're HP or Microsoft, there are some methods of valuation. The most popular is the profit multiple. Take my last deal. The business had $2.1 million of profit, and using that 5 times industry multiplier, you also then need to add on things like cash and property as they belong to the seller separately to the business. Now, in this case, the business was worth $11.7 million, and using the same math will nearly double by late 2016. Again, it's all upside as the business was free to me. You can also use the balance sheet to value a business. You take the assets less the liabilities. This is often called the net asset value or shareholders' funds, in this case $10.4 million, and then you need to add something called goodwill, and that's 2 times the after-tax profit. So net asset value 10.4 million, that's the breakup value if you were liquidating the business. But as it's a going concern, you need to add something for goodwill, and goodwill's the ability for the business and its assets to continue trading and making sales and profits in the future. So if you do the math, you get $13 million now and then $19.5 million in the future. Now, there are some more complex methods for valuation, things like discounted cash flows, real options, but we don't need to know what they are. So back to my earlier point, a business is worth what someone's prepared to pay for it, and in our case it's zero. But what if we needed to pay something for an absolutely top fantastic business? This is where it gets really interesting. We use 2 wonderful things. The first is the structure of future payments. Again, I hinted on that before when we talked about the reasons owner-managers wanted to sell, and also external funding, but once you have taken your slice. Now this is how I did my last big deal. So from earlier, we valued the business at $11.7 million. However, I agreed to pay $7 million to take over the business, but I negotiated $5.3 million of that money to be deferred, and more on that later. So that left me $1.7 million to pay to the seller on completion, but I went out and I raised $2.9 million in funding using the business's assets, and that's what left me with the $1.2 million in cash. Now if you thought that was cool, check this out. The $5.3 million was agreed over a 5-year period for payments, and it will only be paid to the seller if the profits in the business are $2.1 million or higher. That way the seller gets half and I get the other half. The business effectively pays for itself out of the profits after you've been paid. So back to the 2.9 million. This was used for 3 purposes. Some for me, some for the business to grow it, and some for the seller. Now this was a really big deal for me, and I had 2 competing buyers in the process, so I had to pay something up front. Now in some cases you'll not need to pay anything if you just have the right reasons for the person that's selling. Just taking over the leases and the other financial obligations can be enough to get you the business, and I go into that in the negotiation step shortly. But let's use step 5 to show you where the money comes from and all the other sources I actually didn't need to use in that deal. As you can imagine, this is my favorite step as it's where we get paid. Now I only used 2 sources of funding. I borrowed the full 2.9 million against just the invoice receivables and also the stock inventory. I could have really gone to town and used all the other sources listed here, but I just didn't need to. Let's look at each one in detail. Now receivables finance is the easiest and quickest way to raise money. Any bank or third-party funder will give you up to 90% of the value of your receivables instantly. In Matt's case, the receivables were running at 60 days of sales, so that was $660,000 as a book value of those receivables, or trade debtors as we call them in the UK, and Matt was able to secure $590,000 in cash. Although the advance rate for stock inventory is not as high as 90%, it can still be up to 75% depending on the age, the quality and the shelf life of the stock. 40% is a good average. Now Matt got 40% of funding on $250,000 of inventory, so $100,000 was paid to Matt in cash. You can also raise money against plant and machinery, again up to 75% of it depending on the age. In my case, I didn't need it. And you can also get cash from suppliers, either from extending credit terms, or some will actually give you cash to help you grow, as more sales for you means more business for them. Matt was paying suppliers on 30 days when he took ownership, and extending to 60 generated $150,000 in free cash. Customers are also good for cash in the shape of prepayments. You'll be surprised how many customers will prepay for products or services, especially if you offer a small discount. And the same goes for partners. In one deal, I actually got my distribution partner to give me funding for an exclusive contract, generating $230,000. And you could also raise funds against the profits of the business or the cash flow that's generated annually. Funders offer 2 to 2.5 times your annual profit as an additional loan if you need more cash or want more cash. Some, however, may ask you to sign a personal guarantee, which is why I rarely use this. You can also use your pension fund as cash, either as an equity investment or as a loan. If your retirement fund's locked up earning tiny profits or even going down in value, then why not put it to use early? And you can also sell equity to senior employees, external investors, or via crowdfunding. That's now becoming very, very popular. And finally, there are also tons of grant funding pots available. I raised a ton of cash this way for a networking business I acquired back in 2010. The next step is offers and negotiation.
So that's it for this particular video. The next video in this playlist will follow, and please check out all the other playlists and videos for everything you need to know to learn how to buy a business no cash down. In fact, I've crammed everything that you need to know into a special 90-minute webinar titled 3 Insider Secrets to Buy a Profitable Business Inside of 99 Days Without Cash, or Knowing How to Run a Business. And here are the 3 big secrets, the 3 killer training topics. Think of these as hurdles to you becoming a business owner. First, I'll show you exactly what the 10 steps are to buy a business, and you must follow these in order. It's really critical. Second, I'll show you lots of case studies of deals structured using OPM, other people's money, and it's no more difficult than high school math. And finally, I'll show you how you can get others to operate the businesses for you, so you can do other things like spend time with your family or buy other businesses whilst enjoying the cash flow that your new business is generating for you. So to register for this groundbreaking training, just click on the link underneath this video on YouTube or type in this link into your browser. It's bit.ly/buy-my-business. And I'll see you on air sometime in the next week. Until then, bye for now.